Good evening. It's Ty coming to you here from Portland, Oregon, where it is cold. It's cold. I'm in my greenhouse here, and it's an unheated greenhouse, so it's still kind of cold in here. But I'm trying to keep up with my hobby of gardening. One thing I like about gardening in the winter is things don't grow as quickly, so I might keep up with it in between my consulting and accounting and tax work that I do. But speaking of my accounting and tax work and consulting, the reason that I'm bringing this video to you this evening is there was a recent court decision, the Harborside case, which many in the cannabis industry had been waiting for to see if it would yield anything positive or new or exciting in terms of tax law for the cannabis world. And I'm not going to go into a detailed discussion of tax law for the cannabis world and all the different facets here in this video. I'm going to just stick to some quick observations about the Harborside case and leave further discussion about the cannabis industry and tax rules in the cannabis industry for other videos. I'm also not going to discuss every aspect of the Harborside case in this video. I just want to outline a few things and kind of put it in perspective, and then maybe tackle some of the more detailed issues in the Harborside case in later videos. And what I mean about putting the Harborside case in perspective is I can predict, I haven't seen it yet, but I'm pretty sure my colleagues in the accounting and legal industry who deal in cannabis, as well as cannabis operators, we're going to hear a lot about the Harborside case from folks, and that there's going to be let me say some perhaps over dramatization of the results of the Harborside case, particularly in relationship to what it might mean to the tax planning that is done with retailers in regard to how they may have multiple lines of businesses in order to take advantage of the results of the Champs case, which is one of kind of the granddaddy of famous cases at this point in the cannabis industry. So let me get into it that piece into more detail. Well, actually, let's not get into it in more detail. Let me back up and just say this. Let's talk about what actually was decided in this case, what was of interest to set perspective, and then maybe we can tackle some of the details of that in other videos. But there were, in my view, basically four things. Actually, the court case itself outlined four things, so it's not just my view, but the way I'm describing it, of course, will be from my view or in my words. There were four kind of key issues that the case was looking at, and one of them, which I would say is just mental gymnastics on the part of lawyers. Not as much an issue for consultants and accountants like me, because it doesn't ring to be kind of true in the gut. Was the lawyers for Harborside were attempting to make a case that there couldn't be a tax case here because Harborside had prevailed or had basically had a civil forfeiture case dismissed or otherwise it went away. It was decided favorably, and so it wasn't for them anyway. And so the fact that the government didn't win a civil forfeiture case meant that, at least that's what the lawyers for Harborside were trying to argue, was that it meant that there couldn't be a determination by the IRS against them. And in the tax court have said, of course, I think to me this would be obvious, but again, I'm not a lawyer, so I suppose maybe it was worth the time and effort to try to make this kind of argument, but the result came out the way I would suppose it would, which is that's silly. If the tax law, a case relating to the tax law, has nothing to do with whether they prevailed in a civil forfeiture case. So yeah, the tax court said, it doesn't prevent the government from pursuing a tax determination and from this case being decided against the company in a tax court on tax matters, which are different than the civil forfeiture matters. Okay, so setting that aside, so I won't do a video on that because it's not really an accounting consulting kind of issue. It's really just legal wrangling, in my view, that particular issue. But The other another issue that was looked at was which I don't want to be overly dismissive as it being silly, but it's not something that I've ever seen anyone try anyway, so I don't really think it's not something I would probably put in another video either, and that is the Harborside was trying to claim that the language of 280E, and they went as far as whipping out dictionaries and literature and trying to define some of the language in 280E, that the language in 280E prevented 280E from applying to them because they actually had other business activities besides trafficking in cannabis. In other words, they were saying that any business that does something other than, that isn't exclusively selling or trafficking in a controlled substance can't be subject to 280E. That was the argument they were making. And so, I don't know, it's interesting. There may have been some, it was well entertained by the court. Let me say that, because they did get into the dictionary definitions and of the wording being used in 280E, and they did get into the literature and a pretty wide-ranging discussion of it. So I don't know that it was a frivolous argument. I don't know that I would say it's a frivolous argument for the lawyers to make, but it's not a relevant argument to me or to the community that I've worked in, because in our community and retailers that I know that file taxes or whatever, we look at the possibility of having more than one trade or business, and that allowing the deduction of some costs by determining which costs are allocated to the non-cannabis activity. But I've never heard of anyone, this is the first time I've seen anyone argue that the entire activity just isn't subject to 280E because they have multiple lines of business. So this is not a Champs case argument, for example. This is a totally different kind of argument. This is saying 280E just flat out doesn't apply at all if you have multiple lines or businesses. And again, I've never seen anyone take that position in practice, and I've never heard any lawyers locally that I talk to or network with advocate that kind of position. And so it was new to me to read it, but again, I guess why not swing for it? Had they won, that would have been a big boon for the cannabis industry. But I don't know of anyone who was counting on that kind of position. So I don't see that as a big issue either. The issue that I think is more relevant to a lot of resellers that I talk to in the community, and as well as in this industry, and as well as the kind of tax planning that I see coming out of lawyers and the setups, is the issue that is kind of builds off the Champs and Olives cases, and this is that issue of, well, can a seller claim to have more than one line of business, and if they have businesses that are not trafficking in controlled substances, that are not selling cannabis, then could they fairly then say some of their costs relate to the non-cannabis related businesses and therefore deduct those operating expenses? I guess background, I didn't get into a deep discussion of cannabis taxation here. Like I said, I'll have other videos or other topics, other content on that you can look at if you don't already know this. But the background to this is that, generally speaking, the cannabis businesses can only deduct their cost of goods. They can't deduct other operating expenses. And so what they were looking at here was that there's a famous court case, the Champs case, where in that scenario, the organization which Champs is an abbreviation for the full name of the organization, but that organization in California, was in fact operating very different, two distinctly different lines of business or operations. And in other words, the non-cannabis counseling activities in Champs would have been in operation even if the company wasn't selling medical marijuana, right? One wasn't really contingent on the other. And that's why in the Champs case, clearly that the court believed it was appropriate to allow the organization to deduct operating expenses that weren't related to the drug trafficking activity. And we later saw in the Olive case that we saw a dispensary trying to test the limits of this by essentially drumming up some other activities that they didn't actually charge for, but they just said, well, we have these other activities occurring in the dispensary, but the court in the Olive case found, well, there was no profit motive to these other activities. They didn't stand alone. They wouldn't have opened a store and done these activities without without having the store there for the selling of cannabis, and it was clear in that case that it wasn't the same kind of thing as what they saw in Champs, and so they didn't allow them to deduct operating expenses that they claimed in the Olive case, that is, that were related to the non-cannabis activities. So now fast forward, and here we are with the Harborside case, and I think Harborside had slightly better facts than Olive. I'll give them that. I mean, they were selling. They actually had multiple lines of businesses. They had counseling. They had selling of various paraphernalia and doodads, and they also claimed that their branding was a separate line of business, and that's something I'll probably get into in a different video, because I see variations of this and some tax planning people are doing, and I think the result on that issue came out the way I would expect. And so, you know, I think fortunately with the clients that we work with, we've advised them against complicated branding and marketing structures to try to deduct those costs and in some way. And this case might reflect on that. So I'll do a discussion of that later. But back to the way this case relates to Champs, and the reason that in this video I'm wanting to share a perspective as to the way it does or doesn't relate to Champs is I have a suspicion that we're going to see a lot of content out there in the cannabis community of people saying, oh no, the decision in Champs no longer helps us because of the decision in the Harborside case. And I'm just saying at this point, I don't think that's true. I think they're different. I think that, you know, and I think it provides another anchor point to the overall story. You know, you have the Champs case, the Olive case, and now the Harborside case as anchor points to the overall story. But that story is that, you know, what was in the Champs case was that if you have another activity for profit, and like I said, you know, this is a subjective question of whether you have another activity besides the selling of cannabis, whether your store or your business or whatever is actually engaged in another non-cannabis, non-drug trafficking activity. That's a factual question, but it's a fact. When we say it's a factual question, it may be hard to ascertain, and you may be trying to game that answer. You may be trying to make it look like you have multiple lines of business when you really don't. And I would say that's where you're going to get burned, because the reality is that in the Champs case, they actually did have multiple lines of business. They weren't gaming it. It actually was true. They actually did substantive amounts of counseling, and that was something that was a separate activity that organization engaged in. And in the Olive case, it wasn't true. They really weren't doing separate things. They didn't even charge separately for the items. So let's talk about what happened here in the Harborside case. In the Harborside case, with regard to selling doodads, that is, what I'm calling doodads would be, they had things like branded clothing and hemp bags and some marijuana paraphernalia such as rolling papers and pipes and lighters. And so they were selling this stuff, right? And that's not selling cannabis. So, you know, if you had a store that only sold this kind of stuff and didn't sell cannabis, then your operating expenses would be deductible, right? And so the theory, I mean, it's a good theory. The theory is that if you have a store or you have a seller who both sells cannabis and sells this stuff, shouldn't you be able to deduct the operating costs that you can relate to selling this other non-cannabis stuff? That's the theory that comes out of the Champs case, and that's what they were basically testing here. And I would say it was a bad test. It was a piss poor test, because here's the fact. In this case, this stuff they were selling only accounted to 0.5% of their revenue. So it was a very small incidental part of what they were doing, which was the court's point of, you know, okay, this is better than Olive. You're charging for the stuff, but at the same time, it's still not significant. It's not, you know, it lacks credibility, or it stretches the imagination to think that with such little revenue from this stuff that you were selling, that Harborside would have in fact opened a store just to sell this stuff, right? In other words, there wasn't a clear profit motive to this stuff, and that's what the Champs case basically requires. You have to have a profit motive related to the separate activity to claim that you have non-cannabis business-related operating costs that would be deductible. You have to have another activity that has its own standalone profit motive. And when you're selling stuff and it's only 0.5% of your revenue, that is a mathematical indication that it's not really the case that this was an activity that would have been carried on its own with its own profit motive. Now, there are other qualitative factors. If you go to the actual story behind Harborside, Harborside was started with the intent of creating the gold standard of medical marijuana dispensaries. It wasn't started to sell paraphernalia. So the whole company's story, its backstory, its whole essence of what it is, just doesn't lead you to believe that it actually has other activities beyond the selling of cannabis that are truly being carried on in and of themselves for profit, and that's what's necessary. And I would point out that what I'm saying now, carrying on another activity for profit that on its own is its own profit activity, I've used that exact phrasing and that exact consulting with clients and with network contacts who've asked us this question before this Harborside case. I've been using that exact terminology now for over a year, or since the Olive case came out, giving us clear boundaries of between the Champs case and where you could stretch this. So that's what I mean by putting the result of the Harborside case in perspective. I don't think it changes much in regards to the relationship to the Champs case. Maybe it shows us that, yes, not only can you not just give stuff away for free and claim that it's a separate business, but you can't just, it can't be a very minority, a very ancillary, a very incidental part of what you do to claim it's a separate business. Numbers being one way to look at it, what percentage of your revenue is really being taken up by this activity, but just the qualitative story of your business and your company and what your brand really represents would also be figured into that analysis. It is a use good judgment and common sense here, subjective question. Do you actually have are you actually operating a business aside from selling cannabis that you can allocate costs to? And I don't think that the Harborside case has changed the nature of that question. It's just illuminated it yet once again. So that was the main thing I wanted to get out here in terms of perspective on that piece, because I think, again, like I said, I think we're going to see lots of people saying that this is a earth-shattering groundswell of new guidance as it relates to the structures of the planning around Champs, and I don't think so. I mean, it wouldn't, at least not for me. It doesn't fundamentally change the advice that I've been giving businesses in the community on the subject of can we operate a separate business and allocate costs to it. My answer is still, if you actually have an activity for profit that would be carried on its own for profit, then yes, you can. If you're just making something up that's incidental, insignificant, you either don't charge anything for it, or it's inconceivable that you would run it as a separate business without having the selling of cannabis business attached to it, then no, you cannot. And I think that advice was I would have given that advice before this case, and I would continue to give that advice after this particular decision in the case. Okay, so off my soapbox on that particular issue. There's one more issue here that I think is of interest and probably should be explored in another video, and that is the definition of cost of goods sold. The only kind of real definition we've had of cost of goods sold that wasn't quite complete came from the IRS in a 2015 administrative pronouncement. Essentially, they gave us their understanding and their legal interpretation of how you would calculate cost of goods sold for producers and resellers. And what the IRS told us at that time was that they don't believe that 263A, the uniform capitalization rules, are applicable to a cannabis company or applicable to a drug trafficker. And they had various reasons why they didn't think it was applicable, and I won't go all into that here, but my point is that uniform capitalization rules, which were designed to essentially work against taxpayers in the rest of the world, in the rest of the business community, they cause you to take operating expenses you otherwise would be able to deduct and capitalize more of those operating expenses to inventory, which defers the deduction until some later period when the inventory is sold. That's the nature of the 263A unicap issue, okay? And so if you kind of follow what I just said, well, for drug traffickers who can only deduct cost of goods sold, that sounds like great news, because then that could mean that potentially tax planners were thinking, and I would say they should have only been thinking prior to 2015 this was the case, but they could have been thinking, well, we can take costs then that aren't inventory and capitalize them to inventory under these 263A unicap rules. And although they work against taxpayers in most industries, in the cannabis industry, they work in our favor because they increase our inventoriable cost, they increase our cost of goods sold, right? So great, that was the whole thing, but the IRS said no way. They said no way in a 2015 memorandum, and they were pretty clear about that. So if you've been doing it after 2015, you were basically saying, well, we're just not going to follow the IRS's interpretation because we just have our own interpretation. Okay, well, I think one data point this court case, the Harborside case, gives us is they confirmed the IRS's interpretation. So not surprisingly, the tax court looked at it and said, yeah, you can't apply 263A. There's language in 263A that spells out that it's not designed, 263 as a code section is not designed to create additional tax deductions that a taxpayer otherwise wouldn't have. And so 263A cannot be applied in the cannabis industry. They can't be applied to a drug trafficker. So sometimes I say in the cannabis industry because that's the only drug traffickers that I would be interested in or talking to or working with. And so I skip calling them drug traffickers and just talk about the cannabis industry sometimes. But the technical language is any drug trafficker really is what we're talking about in terms of any trafficker of a controlled substance, that is, not just drug trafficker, but yeah. So anyway, yeah, that's where we're at. Is the court has now confirmed that they agree with the IRS's position. The tax court agrees with the IRS's position. I guess the story's not over on that. If other taxpayers want to continue challenging that issue, it could, in that particular question in a different case, perhaps in this one, I don't know, could end up in the Ninth Circuit Court. And of course, if you follow how the legal system works, they could those things can go up all the way to the Supreme Court if they were to choose to hear such a case. But for now, both the IRS has said this, and now the tax court has said this, that 263A uniform capitalization rules do not apply in the cannabis industry, and a company that is selling cannabis would not apply those. So a different argument and I've seen this particular argument being made by some retailers, is a different argument that this retailer at Harborside was making was they were basically saying, okay, fine, setting aside, not okay, fine, but setting aside the 263 unicap issue, a retailer, the way they come up with inventoriable cost that's deductible, cost of goods sold, would be different than somebody who produces. And so they basically said, well, some of the activities they engaged in or the relationships they had with their patients, their medical customers who would grow plants and who they provided clones to, and then would grow plants and then bring product back to them and so on. Harborside took the position that this process essentially made them a producer and not a reseller. And the reason that would be significant from a technical standpoint is that the capitalization rules, the inventoriable rules that lead to cost of goods sold are different. And the moral to that story is producers have an opportunity to capitalize more costs than resellers do. So your resellers, your dispensaries in the cannabis industry, they really get the butt end of the deal when it comes to taxes. Most people in the industry know this, that it's, from a tax perspective, it's a lot better to be a producer. And this is one of the issues involved in that, is that just the simple calculation of cost of goods, more things can get put into cost of goods if you're producing, because in theory, more of your costs are used to create the inventory. Whereas if you're a reseller, you usually aren't involved in producing or creating inventory. You simply buy it, which is your cost of goods. And then everything in your operating costs are essentially end up being selling costs or marketing or other kinds of operating costs that would not be cost of goods that are deductible. So So essentially, in this case, Harborside was taking the position that they had elements of being a producer. Therefore, setting 263A unicap rules aside, they should be able to use the producer regulations under Section 471 to determine their cost of goods. And the court denied that. The court said, no, the few things that you might do that look somewhat like a producer don't really rise to the level of making a producer. You're clearly a reseller, and so the appropriate tax law to use is the tax regulations under 471 for resellers, and so your cost of goods sold should be computed in that manner. So I think that's an interesting technical issue. I probably went into it more here than I should have, trying to keep this video kind of just based on perspective as to what this case was really about, what were the issues in this case that are of importance here, because I'll probably do a different video on that particular topic later. But I guess to summarize this whole thing, stepping back, there were four, again, I'm making this video to set perspective for you all, that there were four issues here. One of them was what I called legal wrangling on trying to say that the IRS could not make a determination and the tax court could not hear a case levying taxes related to this 280E issue because they had a separate case before the government that was dismissed based on civil forfeiture, and so that was one issue. And I said that's not an issue for what I deal with, really. Another issue was whether the company could just say that 280 doesn't apply at all because of some of the language in the code section I mentioned. That was something I had never seen anyone try to do or claim in my world, but certainly an interesting read. But again, I kind of pushing that off the table as not something for further discussion in my world. And so then the only two remaining things that are kind of interest in my world, and the one that I spent a lot of time on, is the relationship of this case to the Champs and Olives case, which was, assuming you agree that 280 would apply to this company, you can't just rule it out altogether. Then can you say that this company had multiple trades or businesses, and can you assign operating costs to the non-cannabis trade or businesses and deduct them that way? And the answer to that is it's fact dependent. This case doesn't say you can't do that. Let me repeat this. This case does not say, it does not overrule Champs. It doesn't say that you can't have another trade or business that you associate operating costs with. In fact, there was a line in the court case where they say, in fact, it is possible to have a separate trade or business for profit that you then have operating costs that are deductible for, and they point out that they themselves, the tax court there in California, that they themselves had ruled that way in Champs, and so it is possible. So this case was just about the parameters of that. How does that work? How do you go about doing that? And what this tested was, well, if you have an incidental business that's a very small percentage of your overall revenue, and clearly would not have been a business in and of itself without the cannabis selling business, then no, you can't say that that's a separate activity for profit and associate costs with it. And then the fourth item again was the definition of cost of goods sold, that 263A unicap rules do not apply, just like the IRS told us back in 2015, and that if you are a reseller, simply engaging in a few of activities that make it look like you could be a producer doesn't make you a producer, and that you would still have to use the tax rules determining your cost of goods sold as any other reseller would. So a lot there. As I'm finishing up this video, I'm realizing that I did a lot more talking, maybe a little bit of rambling, a lot more discussion of this than I thought I was. I thought I was just going to point out the four things that I saw in this case that were relevant and then say wait for more videos. But once I got talking, that's how it goes. I'm a former accounting lecturer at the university, and yeah, you know how that is. When somebody like me gets talking, we don't want to stop. And so I will stop. I will call it good there. It's turning dark in the greenhouse here. And so I'm ready to call it a night, and I will see you in a future video. Take care now.